We have stacked this panel this morning. I'm very excited about it. On the extraordinarily far left, of course, is Grant Williams. First time he's ever been described that way. Grant's the author of a newsletter called Things That Make You Go and this is the newsletter that all the other newsletter writers read. His readership is absolutely global and a who's who of money management. He's the founder of Real Vision TV, and he's moved on from that venture and has a new venture. Can I talk about it? The principle? Let's get to the important stuff. Anyways, read Grant's letter. It's phenomenal. One of the core voices that shaped my journey as an investor. Beside Grant, we have Alastair Still, 25-year veteran in the mining sector, executive at some of the biggest mining companies in the world, like VRIC, Newmont, Agnico Eagle, Placer Dome. 25 years in, and he's still a baby face. Look at this guy, a young man in the sector, bright future ahead of him. Immediately to my left here, we have Frank Giustra, legend, entrepreneur, and investor in the gold sector, founder of many of the companies that you know, including Endeavour Mining, Wheaton River, which became Goldcorp, and Wheaton Precious Metals. And to Frank's left, we have David Garofalo, another veteran executive in this sector and company builder. A major highlight is that David was the CEO of Goldcorp when they merged with Newmont, creating the largest gold company in the world. And this transaction was the largest transaction in the history of the gold sector. So we are quite literally in the company of gold royalty right now. So I want to begin with the last 5 years of the gold sector. There's been a story of maybe two stakeholders, two cross currents. And I'd say if we go back to 2020, maybe 19, the buyer of gold, we had a phenomenal gold rally, and the buyer was Western investors, right? And they drove the price up probably in response to super low interest rates, which often happens. But as we progressed into the next couple of years, interest rates started going up, and those Western investors, those buyers, became sellers. And the gold price fell by about 20%. And maybe capitalizing on that, central banks became the new buyers. That's the other stakeholder, the cross current. And they're buying, massively overwhelmed any selling. And by mid-2024, the gold price had shot up to 70% above its 2022 low. Now, I mentioned those two stakeholders because today they're both still at the table, but they've shifted a little bit. Central bankers are still buying less than they were in 2023, but still buying more than they have on average over the last 50 years. And Western investors are now pivoting as well, and we're seeing the ETF flows reflect that. Western investor sentiment is now favoring gold again. Frank, I'd like to start with you. Have I summarized the last 5 years of gold activity sufficiently? What would you add? And what's your perspective on the space today?
So you're right about the central banks, and I think it's the central banks that are really driving the price, and the pricing power is moving from west to east. And I think the banks will central banks will continue to buy at an accelerating pace in the ensuing years. But you're going to have to wait for part two of this movie this afternoon on my 4:30 panel, and I'll explain in much more detail why that's happening and my theories behind it. But there's also, the other issue is really when you look at gold priced in US dollars, you have to think about why it's going up against US dollars. And what most people don't understand about gold is that it's not the gold price that's going up, it's that the fact that the fiat currencies that are measured against it are going down in value for a whole host of reasons. So gold is always the constant, just like in general relativity. The speed of light is the constant and space-time is the variable. Gold is the constant, it is real money, and fiat currencies are what are the variables that is measured against. And I think you're going to see, as the fiscal situation in the U.S., which is beyond repair. I think that you'll see under the Trump administration, it's my estimation that the fiscal deficits will continue to go up exponentially. At some point, there will be a US dollar crisis. It's going to happen in our lifetimes, probably sooner rather than later. And when that happens, gold will go through the roof.
Grant, I want to pass it directly over to you. Same question, and any comments on what Frank just shared here?
Yeah, it's a brave man to contradict Frank Giustra when he's talking about gold, that's for sure. I think what you said at the beginning there, Jay, it's a really important thing to understand the mindset here. When you talked about the Western investors buying gold and then selling it because the price had gone up, that right there is the difference. In the East, people don't buy gold to sell it because the price has gone up. They buy gold to own it. And when they do sell it, it's because they need to raise money for something important. It's not because the price has gone up. And that mindset pervades us here in the West significantly. I think what we've seen is, in the West, we've seen a lot of attraction go to the tech stocks. We've seen a lot of attraction go to crypto. Anything that is moving is got momentum. The price is going up. This is the kind of behavior you see, to Frank's point, at the end of cycles. There's that last boat out of China, the last hot chopper out of Saigon, whatever analogy you want to use. We're in the point where everything is accelerating now. And the corruption at a political level that Colonel McGregor talked about is accelerating. The price moves in speculative instruments is accelerating. The lack of consequences for any kind of malfeasance is accelerating. And there's this real feel that we're reaching the end of a major cycle here. And because of that, because the cycle is ending, it's time to get what I can out of this, make as much money as I can, steal whatever I can, do whatever I need, because the consequences, as we've seen the last 20 years, are non-existent. And this used to be, I live in the Cayman Islands part of the time, and you get used to small Caribbean islands and corruption. The two are normally synonymous. We're seeing that in the Cayman Islands now with real estate development. The things that are being greenlit to be developed are the kind of things that would never have happened. They would never have gotten through 25 years ago. You move to somewhere like the US, where you expect to see the rule of law, and what do we see with the SEC and the kind of the lawfare against President Trump, the lack of prosecution of anything else by the SEC under Gary Gensler, and this kind of crypto wave that is now becoming much, much more pronounced. So that's a long-winded way of saying we are, to Frank's point, this is going to come to a head. We're in the middle of that process now. And at the end of that process, when these cycles fall over, the one thing you want to own is gold. We are moving into the part of this where it's not a good idea to own gold anymore. It's essential to own gold. And I think the price is going to reflect that in the coming 12 to 18 months.
Well, let me ask a follow-up question to that, because as Frank mentioned at the jump, the gold doesn't change. An ounce of gold 100 years ago is still that same ounce of gold. What changed is the measuring stick. The measuring stick being the US dollar. That's changed a lot. And we have a new administration coming to office that promises to be maybe more fiscally responsible, and they promise to repair the deficit. And let's talk about your forecast for the measuring stick right now, because I saw a campaign run on two promises. One was that we're going to fix inflation, and the second is that we'll add tariffs, which are inflationary, and deport labor, which is inflationary, and reshore industries, which is inflationary. So try to balance those two things for me. Frank, I'll go back to you.
Well, even Musk has been forced to admit that there's no way to cut $2 trillion from the budget. You think about it, when you look at non-discretionary spending, which you can't touch, defense spending, which no one would dare touch, they're actually going to increase it, and interest costs on the debt, you're talking about 86% of the federal budget. There's nothing to cut. And so what's going to happen is that, and I think Musk will last longer, maybe just slightly longer than Scaramucci in this administration. He's going to be gone, and there's no will to fix the problem in Congress, because it's just not there. People don't even talk about it. All they talk about is raising the debt limit so that they can keep going, and that's a farce. They've upped that debt limit about 80 times since 1960. It's a farce. So I think it's completely out of control, and I think you'll see that it's all gonna come to head soon.
Now, David, I want to pass it to you. First of all, any thoughts you'll share on what's been said thus far on the panel?
Well, gold's been a one-way trade for 50 years. Go back to when the gold standard was abandoned. And to Frank's point, gold is a constant. But in US dollar terms, it's gone from $35 an ounce to nearly $2,800 an ounce today. The purchasing power of the US dollar and every other major Western currency has declined by 96%.
96%.
96%. So basically, a dollar today buys you nothing, relative to what it bought you back in the early 1970s. How can it be anything but a one-way trade when global debt to GDP is 350%? The only way to deal with that debt is not fiscally, it'll be through the devaluation, continued devaluation of fiat currencies to basically devalue the debt. That's how debt will be dealt with. So it's a massive currency reset that's inevitable.
Is there any incentive whatsoever to reduce devaluation of the currency for those that control the devaluation?
Given that there's no other way to deal with the debt, it's such a massive level. I mean, to put it in perspective, global debt to GDP back in the 1970s, when we last had a big inflationary cycle, was only 100%. So when Paul Volcker came in and took over the Federal Reserve, he had the latitude to raise interest rates. They went to 20% against inflation. Headline inflation was 12 or 13%. And that's when inflation was actually measured properly. It isn't today. And inflation was dealt with, and we had a period of relative price stability for about 20 years as a result of his efforts. There's absolutely no latitude for central banks to do that today, given the debt levels that we have currently. Again, there's no fiscally responsible way to pay the debt, so you're going to have to devalue the debt, and that means devaluing the purchasing power of the fiat currencies that those debts are denominated in.
I want to ask maybe general panel here. We talked about some of the distractions, I would say, and this comes up a lot in conversation about the gold market. There's more distraction today that's pulling investors away from the gold sector. Now, there's two ways to look at this. One, you could say, that's just a competitor. That's what that is. We need to be more competitive as an industry, provide a better value proposition if you're a company. But there's a bit more to it than that, because there's perception involved as well, that these assets are the same. If you look at like a crypto coin like Bitcoin versus gold, that these assets are the same. They serve the same purpose. There's a variety of perspectives on this, but I want to get the panels. And Frank, maybe we'll start with you.
Don't get me started on crypto and Bitcoin. Listen, this is going to be, when this whole crypto craze collapse, it's going to make tulips look like Berkshire Hathaway, okay? This is a Ponzi, a pyramid scheme, and it's a cult. I don't know if any of you guys are on Twitter and watch the Bitcoin maxis. They're insane. They try and bully people and shame people into buying Bitcoin. The Bitcoin community spent $245 million on the election campaign to bribe Congress and even the president to change, ease up on the regulations on crypto. But and Michael Saylor, I don't know if you guys might follow Michael Saylor, but he is beyond insane in the proclamations that he's making. He would make Charles Ponzi blush. This guy has said that, but he's got such a huge following that there's a whole contingent of people that believe it when he says that $500 trillion, the global bond, all the global bonds, $500 trillion is going to go all into Bitcoin. The Bitcoin's going to $13 million a coin. These are ridiculous. The gold's going to zero. These are ridiculous statements, but he needs to make those kind of statements to keep the greed factor going, because in any pyramid scheme, you need to have new buyers all the time to keep the game going. And so he's trying to get the greed reflex happening, much to my amazement, I debated him 4 years ago, and much to my amazement, people still believe him. And so I think that this thing is going to take, when it implodes, it's going to take the financial system down with it. It's going to have a huge effect, and that's been the distraction. A lot of the distraction from gold has been because of the idea that crypto is a store, or Bitcoin is a store of value, which has never behaved as a store of value. They've changed the narrative so many times on Bitcoin that it's starting to sound like the plot of Gone Girl. I mean, it's really, they keep trying to find a purpose for an asset class. It's an asset class in search of a purpose.
Okay, so thank you for that, Frank. I think I want to move on to investor sentiment in the gold sector a little bit, Alastair, and I want to start with you, because you're running a gold company, you're traveling, talking to investors all the time. I began this panel by discussing the two main stakeholders that have existed for the last 5-6 years, being Western investors and central banks that have been driving the back and forth of the price. What are you seeing, Alastair, from an investor activity and sentiment standpoint right now?
Well, I think it's a great question, and one of the elements I think we haven't discussed here is, certainly like many on the panel here, I'm bullish on the price of gold, but what's also at factor here is the scarcity of the metal. And to the point of Bitcoins can be created every day, you can't create more gold. It's a finite amount. It's found where it is. There's limited supply of it. That's what makes it scarce. That's what gives it value. And what we've seen in the last several years is that scarcity is being tested. It seems the world is often shrinking in geopolitically stable jurisdictions where you want to operate in. We're seeing challenging environments where certain operators have had challenges. So having a solid operation with a solid reserve in a geopolitically stable jurisdiction, those types of resources are becoming increasingly scarce. I think that's one of the factors driving price here. And I think it's one of the factors that many of the operators, are pushing towards and to clamber to get new assets. So while I think many of investors are a little behind the curve, what we have seen is the major operating companies, they're running deficits in their reserves. So they're not replacing what they're mining, and that's because they've been underfunding exploration for years. So now they're on the acquisition trail. And I think it's targeted M&A activities to fill their pipelines. I think that's an opportunity for the junior explorers, the junior developers to fill that void, where many of the investors haven't yet caught on that these assets themselves may not go into production tomorrow, but they're being sought after and chased by the majors who are willing to pay a premium to acquire them.
Okay, I have two questions for you following that statement. So first of all, you mentioned the geopolitical risk factor being a bit bigger today. We've talked about gold becoming more of a strategic asset for central banks. They've been buying in copious amounts for a reason, right? When you don't know what's going to happen next, the asset that has no counterparty risk is a good one to own. I believe that's behind a lot of the central bank buying. So if it's becoming more of a strategic asset, and geopolitical fracture lines are definitely deepening around the world. Do you see more countries being a lot more strategic with where they're sourcing their gold from, how they're buying and selling, the location of the deposit today? Does it matter more than ever as we become a bit more divided on the chessboard?
I think it does very much matter. The other thing I think is becoming increasingly important is what byproducts or other metals occur with the gold. I think it's a much easier message to deliver or a investment thesis when the gold's occurring with something. For example, gold often occurs with copper. If you can have copper occurring with gold, that's a strategic reason to make an investment. It's often a reason to get communities or stakeholders involved or governments involved when they see it beyond just gold. Not just copper, though, but we see a whole suite of other metals that are becoming even more prevalent today. Antimony and other metals that are needed to drive economy. So I think the byproducts are an important piece. Different jurisdictions recognize that. So it's not just the strategic value of gold, but it's a whole suite of other metals that may occur with the gold, makes it that much more valuable.
Okay, my second question there, you talked about the scarcity of production. Peter Spina, one of our speakers here at the event, recently put out a tweet talking about the concept of peak gold. He said, "I believe we've hit peak gold. And I believe that for the next 5 years, we'll see a 17% reduction in production every year." That topic seems to be pretty hotly debated online. Peak anything always is, but what's the panel's take on the concept of peak gold? And maybe explain it a bit for us, if you don't mind, Alastair.
Well, I think you're right. I mean, there's certain investments that need to occur years in advance to get production ready to be in a state that it can be mined. So we've got that factor. The exploration has been underfunded. The other thing I think people have to also recognize is that in a strongly rising gold price environment, operators will mine at lower grades. And that's because they don't want to leave material behind that has value. So you come to a decision. Do you mine the 1 gram dirt today and make money, or do you chase just the highest grade portion of it? At a higher price, the operators are mining lower grades. That doesn't necessarily mean they're making more gold. They might make more profit, but they're actually potentially mining less gold. So that rising gold price actually, in many cases, and we've seen that from the major operators, means they're mining less gold at the same time as well. So two factors at play there, amongst many others.
Yeah, so the concept of peak anything is always at risk of being adjusted by technological innovation or just higher prices. David, any thoughts on that?
Yeah, look, I think to sum it up, large-scale operators in our universe are doomed. They're facing a squeeze from declining reserves, and reserves are down 40%. And that's empirically demonstrated because the juniors haven't had access to capital for over a dozen years. They're the ones that do all the heavy lifting and exploration. They're not replacing what we're depleting as an industry. And we're also facing cost pressures in the industry. So the operators have seen a squeeze in their all-in sustaining costs. If you look at the R squared, the correlation between the gold price and all-in sustaining costs, it's like 97. So in other words, the costs are rising with the gold price. They're not getting leverage to the commodity because they're vulnerable to inflation we're experiencing in the general economy. That's why when you look at the leaders in our industry, the Barricks and the Newmonts, their share prices are lower today than they were 30 years ago when the gold price was a tenth of what it is today. So they have not provided leverage. They're facing, again, increasing operating costs, but also the squeeze that comes from underinvestment and exploration for well over a decade. And that's not going to reverse itself anytime soon. I think inflation's much firmly entrenched, more firmly entrenched than the headline numbers will indicate. Again, those inflation numbers are definitely, they're definitely messed with. We don't have a real axis, a real measurement or barometer of what real inflation is. And all these companies can do, the larger scale companies can do, is cannibalize. They're going to continue to grow their share count, but they're not going to grow their reserves and production. So if you look at the Barrick and Newmonts today, they're at the same production level, reserve level they were back in the mid-1990s, but their share count has grown exponentially. So the per share value creation simply is non-existent. Where you want to be in the industry is in the development stage assets, the ones that are going to populate the pipelines that these larger scale companies are going to desperately require. And I should set the record straight. The deal I did with Newmont was the biggest deal for 5 years. And then Newmont had to go and do Newcrest 5 years later. They had the Eclipse, what they thought was a deal that would set them up for 10 to 20 years. It didn't. They have to continually gobble up other companies, play Pac-Man to replace a suboptimal production and reserve level. Is simply not sustainable.
And is the only sustainable growth path forward then to look further down the food chain then at new deposits? I mean, as you mentioned, reserves are down 40%. From what's the timeline, or what would you think the timeline there?
Over 12 years.
Over 12 years.
Since 2012. Right. So you remember we had a fairly robust market for juniors coming out of the great financial crisis, and they were able to raise money. And then what happened in 2012 is we overbuilt as an industry, overexplored, and investors said, you know what, enough debt, enough building, enough cost inflation, give us our capital back. So the industry has basically been giving money back to investors for the last dozen years in dividends, share buybacks, and whatnot, and have not invested meaningfully back into grassroots exploration to replace depleting reserves. And that's why we find ourselves in the dilemma among the larger cap universes that we find ourselves in today.
And just for context, because I know a lot of you are here for the first time ever, once again, love that. When David talks about reserves, that's an economic mineral deposit. You'll hear a lot of people talking about resources today. A resource is a geological discovery, and it's measured based on geology. When the geology proves favorable enough, it's upgraded to a reserve. So think resource, geology, reserve, economics. Okay, that's the difference. So when David says that reserves are down 40% over the last 12 years, that means the amount of gold that we know about that is economic to mine has decreased by 40%, and that's the problem that these major gold producers are running into. So they can't just go and buy more major producers. They can't merge. They have to find new reserves. That's the challenge the industry faces. Frank, what's your take on the health of the gold sector today? Because, you know, you could say a lot of the investor sentiment is driven from bad memories of the past, of egregious G&A, poor management, bad M&A deals back in 2011. What's your take on the sector today from a health standpoint?
Well, I think, you know, there are a lot of reasons why this sector is not getting any love from institutional investors. And, you know, you can blame crypto, which is distracting people, ESG, which has created this idea that mining is dirty, and people haven't connected the dots yet that mining is necessary to get to clean energy. So that's a whole other thing. But I think it's also, the industry itself is partially to blame. There are far too many companies burning a lot of overhead. This industry needs to consolidate. We need to deliver performance, you know, and so it's partially the industry's fault. You know, for a long, long time, it hasn't performed. And you need to perform, you know, economically with your deposits to to qualify as an investment sector. So I think that that's part of the reason. There's just far too many companies. We need to consolidate this industry.
I want to pass it back to the panel now and say, you know, this is an investment conference. It's a bunch of retail investors. There's too many companies. That makes the investor's job quite hard because you're sifting through a really big pile in order to find the winners. I always say your job isn't to pick the winners in this industry. It's to get rid of the losers as fast as you can. And then what's left is where you have a good shot at finding something great. It's impossible to pick the 10X, but you can identify the losers much quicker than that. Do you think I'm right with that? And could you provide some counsel and guidance on where investors should look today? And feel free to talk your book, please.
No, if you look at my investment portfolio, I'm not one to give recommendations.
Jay, I would jump in here. I think everybody in this room, whether you're an experienced resource investor, and I see a lot of familiar faces here who I know come here year after year, but there are a lot of people that are new to this space. What David just said, if you can find a transcript of that somewhere, get the video, transcribe it for yourselves, carve it into a stone tablet, that may be one of the best lessons you're ever going to get in terms of how to think about what this industry is, how to go about finding the right companies, and how to think the way that the executives running these companies have to think. Because, you know, gold is many things. Gold is a get-rich-quick scheme, it's a get-rich-slow scheme, and it's a stay-rich scheme. And at different points in the cycle, it performs a different task. And if your motivation here is to go into the resource stocks, take advantage of the leverage they offer, what David just told you there is literally, David, it's one of the best short lessons I've ever heard in this space. Congratulations on that. But if you want to look at gold as a stay-rich scheme, which is at this point in the cycle how I look at it, because I think there's going to be a lot of wealth destruction that takes place, and gold will protect you against that. It's a very, very different mindset. You know, we had a tremendous panel before us, and if you were here for that and you heard Pippa and Colonel McGregor and Pascal talking about the world, the one thing you must have taken away from that is change. There is a lot of change coming, whether it's in the gold space, the financial sector, government, geopolitics, technology. Change is upon us. And if you think what the last 40, 50 years have been like, you know, rising markets, rising bond prices, everything's been great, low inflation. Just think about change and think about the world we've had that's been so easy for so many people to make money, and change that. At its very basic level, it's going to be much harder to make money. It's going to be much harder to hang on to the money you've made. And so whilst there will be any number of opportunities in this exhibition hall to find companies that are going to perform really, really well in a gold bull market, that shouldn't be your only focus. You shouldn't only be thinking about, hey, where can I find the 10 baggers? Because if that's really your mindset, crypto is the perfect vehicle for that. Because there's a 10 bagger produced every minute if you're lucky enough to get in and get out. This industry is, as Colonel McGregor said, it's tangible. It's things that you pull out of the ground that are valuable. And so try and think about what it is you want to achieve by being here and by looking at, researching and investing in the precious metal space. Listen to what David said, get a transcript of it. I promise you will read it over and over again. And once you understand what your objectives are, that's when the work really starts.
If I might, Jay, I probably think about investing in the gold sector as a bit of a barbell. At one side is focusing on good geological models, because the industry definitely has a scarcity of reserves, as Alastair correctly pointed out, and he's doing God's work at gold mining now, developing some large-scale deposits that clearly the seniors desperately require to replace their depleting reserves and production. So focusing on good geological models, companies that are de-risking assets that the seniors are going to need desperately. It's an existential crisis for them. The other end of the barbell is who's providing the capital to develop these mines. And that's why I'm running a royalty vehicle today. I don't want to run a producer. I sold a large-scale producer because I frankly thought that end of the sector was doomed. I just didn't see any way to create value. All we could do is print more stock. We couldn't grow our ounces. So focusing on the royalty companies that provide you unmitigated leverage of the gold price and leverage to the exploration of the underlying operators that own the assets protects you from inflation. That's a great model as well in a rising gold price environment with significant inflation that we're going to inevitably continue to see in the general economy that will infect the supply chains and the costs of the producers.
Alastair, I want to give you the final word.
Well, maybe one point to add to that is, to the investors, is don't overlook the basics. We've heard touching on it here, but there are fundamentals that every company should have. That's what you should be looking for. It's stability of the assets. You need to look at what's in the portfolio. You may want to go for a flyer who's got one asset, or you may want a company with a stable portfolio of assets with optionality. Gold mining is a company that has that. Other companies have single assets, which maybe have a higher, shorter-term leverage point to them. The other thing is, don't overlook who's running the companies. I mean, everyone can tell a story, but who's done it before? Who's got experience having run it with operating teams, jurisdictions? Who knows how to do it? And then look at the capital structure as well. What's going to happen? Should they do a raise? Does the capital structure get blown out? Do you get diluted to nothing? So fundamentals are still key when making any investment. I would never overlook the fundamentals and optionality in a portfolio.
And it starts with the people. Frank, one more word.
I know we're in overtime now, but if I just want to add one thing that on the demand side of gold that I think many people in this audience will not be aware of. The World Gold Council, first, we need to make gold appealing and technologically convenient for the TikTok generation, okay? They've been playing the crypto game. And the World Gold Council, for the last 5 years, has been working with the 20 largest LBMA banks, bullion banks, to create digital gold. I just had a recent conversation with the president, David Tate, in London, and he walked me through how it's progressing. So they've been at it for 5 years. They have to lay an entirely new infrastructure of fiber optics to make gold, the settlement of gold, instantaneous, as opposed to now may take up to 6 hours. And what that's going to do, and they're going to create a digital coin that is going to be divisible up to 1/100 of a gram. So it'll be available to the general public. But the more important part is that although gold is a tier 1 asset with the Bank of International Settlements, it's not with the commercial banks. It gets discounted 85% as collateral. So 15% value in collateral is going to change overnight because now the risk managers of these banks will allow, with all the transparency and the data that they didn't have on volatility, they're going to be able to class it as a tier 1 asset and get a lot more lending power against those gold positions. So it's going to be good for the public, the TikTok generation, and the banks.
I love it. And access. Look, and one comment that Alastair made here was how important the people are in these companies. And that's what we're doing here. All of those companies out there, the CEOs are on site. They want to talk to you. Go talk to them. Make sure before you let somebody have an adventure with your money that you look them in the eye and ask them some hard questions. Both David and Alastair are running companies out on the floor right now. You can find them out there, Gold Royalty Corp and Gold Mining. Everybody on this stage will join me once again on this stage or a different one throughout this conference. Ladies and gentlemen, that concludes our panel. Please give them a round of applause.